When you buy a stock, you're not just buying a ticker symbol on a screen, you're buying a piece of a real business. If you were to buy a business, let's say a small restaurant or a factory, would you do it without understanding what the business does, how much money it makes, or whether it has too much debt? Of course not. But most people don't apply the same logic when investing in stocks. That's why we need a structured framework for picking stocks, the same way a serious investor evaluates a business before buying it. In this video, I'll introduce a simple yet powerful stock picking framework that will help you analyze any stock with confidence. And in the next videos, we'll go deeper into each part. Stay with me till the end and you'll walk away with a rock solid approach to evaluating stocks like a pro. Now, most people buy stocks based on tips, news, or stock price movements. Maybe a friend says that this stock is going to the moon, or you see a stock shooting up and you feel like you're missing out. Sound familiar? But there is the reality. A stock price going up does not mean that it's a good investment. A stock is only as valuable as the business behind it. Think about it like this. Imagine someone offers to sell you a small business. Would you buy it just because they said, "Trust me, it's a great deal"? No. You would look at its financials, how much money it makes, and whether it is worth the price. And that is exactly what we should do with stocks too. So, how do we analyze stocks like a business? We follow a 3-step framework. The first step to look at is valuation. No matter how good a company is, if you overpay for it, your returns will suffer. Valuations help us answer, is this stock cheap, fairly priced, or overpriced? We use valuation ratios like price to earnings, price to book, and EV upon EBITDA. Think of it like buying a house. Would you buy a 2 BHK in Mumbai for 5 crores because it looks nice? No, you would compare prices, location, and future value. The same applies to stocks. A profitable company with too much debt can still be a risky investment. A company with strong financials can survive tough times. We check its assets, liabilities, and cash reserves. We analyze debt levels. How much debt is too much? Cash flow is king. A company that consistently generates cash is much safer. Think of it like personal finance. If you have a stable income, no debt, and savings, you can handle financial shocks. A company works the same way. Now, a business should not just survive, it should thrive and generate solid returns. We look at return on equity, return on capital employed, and profit margins. We check revenue and earnings growth. Steady growth is a great sign. Imagine 2 stores. One grows revenue every year, reinvests in expansion, and maintains good profit margins. The other barely grows and keeps losing customers. Now, which one would you invest in? So, that's our stock picking framework in very simple terms. Valuation, is the stock fairly priced? Financial health, can the company survive and grow? And profitability and growth, is the business making money? And in the next video, we'll start with step 1, valuation. We'll break down PE ratios, intrinsic value, and how to know if a stock is overpriced or a bargain. Now, tell me in the comments, what's the first thing you check before buying a stock? Do you look at valuation, financials, or something else? Also, if you found this useful, hit that like button, subscribe, and turn on notifications so you don't miss the next video on valuation. Thank you for watching and see you in the next one. Also, if you want more discussions on the topic, please join our Telegram group. The link is in the description below.